The biggest problem or the biggest myth, I would say, is that many people believe that higher returns come from higher risk. That is, if you take on higher risk, you will get higher returns. People think that if I plot risk in the x-axis and returns in the y-axis, it's a straight line. So if I take more and more risk, I'll get more and more returns. That's a big myth. And if you take on more and more risk, what happens is the spread in possible returns becomes higher and higher.
Today's guest is Dr. M. Pattabiraman, an associate professor at IIT Madras and the founder of Fincal, one of India's most respected personal finance platforms. Over a decade, he's helped millions of Indians think more rationally about money, investing, retirement, and financial independence. He's also co-founder of Fee Only India and a leading advocate of evidence-based, low-cost, goal-oriented investing.
Thank you so much, sir, for joining Expanding Horizons. I want to start off by asking about the current market conditions. So we've had the US-Iran war, oil shocks, INR depreciation. There's been like AI disruption as well. So given all these things that are happening, does this change anything for ordinary investors?
See, I think this has been a rude shock for a lot of people, particularly those who started investing in mutual funds, looking at their marketing campaigns and the mutual funds Sahi campaign, and also during COVID. That's when the number of demat accounts and the mutual fund AUM, really picked up. And I think that generation has not seen a proper bear market. They may have seen a small crash. COVID crash was pretty small by standards because it recovered quickly. Therefore, it was small. And they have not seen a sustained bear market. And this is the first bear market for a entirely new generation. And that's a big chunk of people. And so they're learning a very important lesson in about stocks, about equity mutual funds, that the returns can be extremely non-linear. Suddenly you'll get a huge return. Suddenly there'll be years and years of no returns. Forget negative returns. There'll be no returns. I mean, 0%, 1%, 2%. You'll be getting less than an FD or less than a PPF, and that can really frustrate you. And that's what's happening. See, I am not a big fan of investigating why this is happening, because I don't think it can help. Because I think the ordinary guy cannot go and determine foreign policy or change what happens in the markets, or they're basically the recipient of good and bad, and they can't really change. So I would suggest to have a very robust portfolio that can handle ups and downs. There will always be some reason for a market to be down and some reason for a market to be up. Whether it's rational or not is a different matter. But I am not a big fan of investigating it or writing about it and so on, because the main thing is, one, you must have a long-term horizon in equity. Otherwise, you should not be investing. What the bull market did was that people saw 1 or 2 years of spectacular returns and said, I'm going to invest in equity mutual funds for 2 years, 3 years. And they are in big trouble, because they will face the biggest problem, because they don't have really a plan and they don't have anything of an asset allocation to talk about. But for those who have a long-term horizon, more than 10 years away, more than 15 years away, I think they should think of this as a warning call and first diversify their portfolio. Hold not more than 50-60% of equity, which is what I've always been recommending, and the rest should be in good fixed income, steady, good fixed income. If they do this, then they can weather these storms. And that's the main thing which most people are not doing. And I think it's been a wake up call from that.
And what do you think about international investing? So, given the USD INR depreciation, and considering like the other markets have performed well, there are some who are now looking to like international funds, international stocks. So, are these going to become more important? Will we see like more people investing there? Is it a good idea to increase allocation towards these international funds or stocks?
I think we should go to the mirror and ask ourselves, why are we looking at international markets now? For the simple reason they're done better than Indian equity. That is the only reason. There's no other reason. People use fancy words like diversification, asset allocation without understanding what they really mean. People say, I want diversification, so I want to invest in international stocks. 6 months ago, 8 months ago, people said, the same guys would have said, I want to buy gold for diversification because gold was zooming in the last quarter of 2025. Gold was moving up and everybody wanted to buy gold, then they wanted to buy silver. So it's basically shiny object syndrome. They see something shiny and that seems to be more shinier than what you already hold, and you want a piece of that. That is basically clutter. You are just accumulating clutter in your portfolio, and that is not proper diversification. Proper diversification means that you understand that markets will move in cycles. All markets will move in cycles. If today the Indian equity is down, and let's say the Chinese market is up, the European market is up, the US market is up, then the cycle will turn. So at that time, when the US stocks are doing badly and when the other international markets are doing badly, do you really have the maturity to hold and those stocks or those funds, those ETFs at that time and say I'm holding it for diversification? Really, frank, most people don't have that kind of mentality. They just want something shiny, and this mentality that your portfolio should have only winners is completely wrong. If you are truly diversified, your portfolio will always have underperformers. And that's the essence of diversification, right? You are so, which means that when you have outperformers and underperformers, you periodically sell the outperformers and buy the underperformers and rebalance the portfolio. So there's absolutely nothing wrong with holding gold for risk management or holding international stocks. But one, you should do it for the right reasons. Two, you should understand that there'll be ups and downs in all markets, all asset classes, all asset types. And three, do you know how to manage this portfolio? Do you know how? Are you willing to rebalance? You should look at the asset allocation once a year and rebalance if it moves beyond uh, a 5% threshold. If the deviation is more than a 5%, are you willing to do that? Most people are not. They will say, no, 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 I'm scared of tax, I'm scared of exit loads. They will try to adjust their investment amounts to rebalance. They will say they will adjust that. I've not seen anybody properly do it. So I think the desire is there, but the intentions are not right. The desire is always there. It's just to hold something shiny, but the intentions behind it are not well planned. That's true for most people. And if you look at how our social media functions and people who sell products on social media, they will always use FOMO to sell it. People who sell is, I don't know, I don't even think it's possible to be in the financial services industry and not use FOMO. I don't think anybody can except me. There are very, very rare exceptions, like probably Parak Parik FlexiCap Fund, or how the Parak Parik AMC has gone about its business. Everybody else uses FOMO. People who are pushing international investing today, they're all using FOMO. Look what you did. Everything is look, that's shining. You're holding on to something bad. The INR is depreciating, and you're holding on to losers. So, and I think it's very easy today to give in to that FOMO, and people cannot forget about portfolio management. People do not know how to process information in social media. They just don't know. And the best way to process information in social media is to not have any information at all. That's the absolute best way. Not just stay away from social media. That's the only way your portfolio will be healthy, in my opinion. My social media presence is extremely minimal, and I'm very happy I belong to an older generation who doesn't need to post online if they've touched their nose in a way. So I'm very happy I'm not part of the younger generation who wants to keep posting about everything that goes on in their brain. So I think it's noise management is the most important thing. Portfolio management comes later. First, you manage noise. How do you manage the noise around you? Everybody is saying this is doing well. Oh my God, the Indian equity is going down. It's not moving up. The FIIs are going away. The INR is depreciating. Oh, is me doomsday. Blah, blah. And I have been hearing this doomsday for 15 years. And I've been hearing people say a big crash is coming. A big crash is on the way, right? I'm not saying it won't come. I'm saying it won't come on cue. It won't come just because somebody said it. It doesn't work like that. So I think some patience is necessary, and most people don't have that. That's the problem.
There are another class of investors, I would say, the more contrarian types, or who might be, think they're think that this is a market dip. They say, okay, the market is crashing. Let's go and buy the dip. So they might increase the SIPs, they might do lump sum. Might not be a big percentage. The ordinary investor will get away, but there are some that love to buy the dip and they'll keep throwing info. So does this still make sense, or does this contrarian investing become like dangerous at some point, or is buy the dip still a good strategy?
See, it's all done with expectations, right? When you are making a value buy or you're making a contrarian move, you are expecting to do something better than others. That's where the problem lies. When you are buying the dip, you expect the return associated with that particular investment to outperform your general market returns or your average SIP returns and so on. That expectation is where the problem lies. I have no problem in buying the dip. In fact, I think people should invest regularly. And if they have excess money, first of all, they should wonder why they have the excess money. People always say, I have some cash lying around with me, right? My question is, why do you have cash lying around? If you have cash lying around, something is wrong with your management. You have done something wrong. Everything should be accounted for properly. And people say, I have gunpowder, I have dry gunpowder. And so is it really doing any work, being dry and staying waiting for the right opportunity? I'm not a big believer in that. So I believe in regular investing, but you can invest by the dip, but please recognize that market volatility will wash out all dips. Today, if you look at the Sensex chart or the Nifty chart and ask yourself, can I point out the dip that happened just before the Lok Sabha results were announced or during the counting process when people thought there will not be a majority government? The market dipped that day, right? If you look at the Sensex chart today, you cannot point out the dip because it's all washed out. It's completely gone. So it's not really a dip. That dip will get, the market fluctuations will wash out the dip. What will remain is big corrections. For example, the COVID crash, the taper tantrum that occurred in 2013, the 2008 crash. Those kind of big crashes, no more than 25%. Those kind of things are the only ones that will be seen over the long term. Some 2% dip, 3% dip, 5% dip, all those will not be seen, which means that the benefit that you will get from that particular dip investment will be minimal over the long term. So it's just going to get washed away in market volatility. As long as we have the that appreciation and invest with the right expectations, I don't have a problem with it. But the bigger problem is, what are you doing? Why are you having excess money? If you have excess money, I think there's a big problem which we should first address.
Yeah, I mean, that excess money probably might be like lying in debt or liquid funds, which probably can get
I agree, but I
removed.
mean, there should be a plan. Most people don't have
Yeah.
a plan. See, they don't have an asset. They see an opportunity and they just relinquish asset allocation and want to shift to this. That kind of things can be very dangerous. Do you have a plan? Is the first question people should ask themselves.
Next thing I want to touch upon is passive investing, passive versus active investing. So over the last few years and a decade or so, we've seen a rise in these passive funds. There's been like index funds easily available, and it's highly recommended to go passive for the ordinary investor because beating the market is a little harder. But is there a point where the passive AUMs get to such a level where it's actually becomes a problem, where it might be like, oh, 70% of it is in passive investing? So is there a point percentage where passive exceeds such a large level that actually active funds beating the market makes more sense?
See, first of all, I think this active or passive investing is just another, meaningless social media fight, to be frank.
Okay.
See, that is a secondary consideration. First thing is, do you have a proper financial plan? Do you really understand why you need to invest? How much money do you need for that future expenditure, retirement, children's education, whatever it is? Are you investing in a proper diversified portfolio? Do you have the right asset allocation? Then only you worry about product categories, and within the product categories, you worry about whether it's an active product or a passively managed product. That's the last step. See, this is a big problem. If you look at this, for example, this thing happens between book readers and movie watchers. The book readers are always holier than thou. If you have noticed, those who read books, They'll always say, oh, you watch videos, you watch movies. I don't think you'll have the same experience as reading books. They're always holier than thou. The same thing happens in the active and passive investing crowd. The passive investors are holier than thou. They think they're some elite breed who are not worried about alpha, who are chasing after low expenses instead of the other way around and so on. I think it's irrelevant. First of all, do you have a proper financial plan? Then you do whatever works for you, whatever helps you sleep better. But don't go about boasting that you have made the best choice, because there is no best choice. Anything it should be fine. Whether you choose active funds or whether you choose passive funds, it doesn't matter. Sometimes some active funds will do better, sometimes passive funds will do better. Sometimes by luck you may be holding the outperforming active funds, sometimes you may be holding the underperforming active funds. So it just, again, over the long term, all these things is just a moot point. To answer the other part of the question, it's a technical question. You are asking whether AUM becomes a problem for passive funds. Now that's a technical thing. I would think that if I'm investing in a market cap weighted index fund where the higher market cap, free float market cap will have higher weightage, particularly in the large cap segment, I don't think the AUM will become a problem. And if you notice, I think in 2018ish, 19ish, maybe a lot of EPF money came into the index. That is it came into the SBI ETF and another one more ETF and so on. That did not change anything in the market. It just, those funds managed quite well because there's a lot of liquidity. The large cap stocks, you can buy and sell large quantities of large cap stocks freely without impacting their price. Right? There's something called impact cost, because when you try to buy and sell 1 million shares of some particular company, will that event affect the price? For large caps, it will not, or not so much at least. It'll again be just noise. But will it be the case for small cap index funds, mid cap index funds? I am not so sure. I don't know. That's what I would say. A large mid cap fund, a large mid cap index fund, a large small cap index fund, how will they behave during a market crash or when the buyers evaporate, particularly in a market like this? We don't know. We do not have enough information on that. And I would say I would be a little cautious. And I'm not a big fan of definitely not investing in small cap index funds. Maybe mid cap index funds should fare a little better, but we don't know. We don't have enough data because they're all new products. So I would be a little bit more cautious there.
I want to touch upon that point on financial planning and having like a goal. And also, when you ask an ordinary investor and common people, why they invest, most people say they invest to make more money for wealth maximization. Very few will say they do goal-based investing. It's getting popular, more people are there. So, but why is like wealth maximization or just getting more returns not that great of an idea when you compare to goal-based investing? Why is goal-based investing a better framework, let's say, to just maximizing one's wealth?
I don't think it's a better framework. My thing is that everybody wants. See, this is like, I want more money is something that everybody wants, right? There's a difference between saying I want more money and saying this is how I'm going to make more money. There's a big difference. There's a dream and there's a goal. So goal is a dream with a destination. I'm just not dreaming. I'm having a destination, and of course I want to maximize my wealth. I want to maximize my retirement corpus. I want to maximize the money that I will save up for my kids' education, because that gives me more options and so on. It's obvious that more money is better, more returns are better. But if I don't know my destination, how am I going to start my journey? That's my problem. I don't have any problem with wanting more money, wanting more returns. However, the biggest problem or the biggest myth, I would say, is that many people believe that higher returns come from higher risk. That is, if you take on higher risk, you will get higher returns. And people think that if I plot risk in the x-axis and returns in the y-axis, it's a straight line. So if I take more and more risk, I'll get more and more returns. That's a big myth. And if you take on more and more risk, what happens is the spread in possible returns becomes higher and higher. So there's a spread. For example, if I invest in an FD, there's no spread in the returns, right? 7% FD is 7% FD. After 10 years, I'm going to get that 7% unless the bank goes fat and so on, or the economy goes fat. That's a different matter. But under normal circumstances, there's no spread in the returns. Whereas if I invest in a liquid fund or money market fund, there is a small spread. I'll get maybe 6 to 7% or 5 to 6%. There's a small spread. But if I invest in an equity fund, that spread, it becomes larger and larger. And for over the short term, if I invest in an equity fund for 3 years, 4 years, that spread can be somewhere between, let's say, minus 20% to plus 20%. But if I invest in 15 years, that spread becomes smaller, but it doesn't go to zero. That spread will probably become something like, let's say, 7% to 15% for over 15 years. So that's my spread in returns. So that spread means that I can end up getting a bad return. I can invest in more mid caps, more small caps. And after 15 years, if I catch a period like this, current market conditions, my returns can be very poor. And I have taken more risk, but I have not got the commensurate reward. So this idea of running behind more returns, I think it has to be done with proper risk awareness. And if you ask young people, they say, I have a lot of risk appetite. I don't know what risk appetite means. Risk appetite is a complete unknown. I've been doing this investing for some time now, and I don't know what my risk appetite is, because tomorrow I don't know how I will react if the market corrects by 50%. If it drops 50%, I don't know how I will react. So we don't know our behavior during bad periods. And therefore, unless I know about potential risks in my investing, I'm aware of the risks in my investments, I cannot frame my risk appetite in a meaningful way. And therefore, I'm saying, first of all, be aware of the risks and then you chase after returns. There's nothing wrong in chasing after returns. That's how I see it.
Right. I also want to talk about this concept of FIRE, which is popular amongst like younger professionals, and it's also gaining more prominence in the past decade. So when I look at FIRE and when I talk to people who are nearing retirement, maybe 50-year-olds, 60-year-olds, they don't want to retire. Many of them are looking to work. Many of them want to continue working. They have built their career. They want to stay invested. So when you see 25-year-old, 30-year-olds, they want to retire early, but the other end of the spectrum don't want to retire. So are like the younger professionals forgetting, or like what is this chase after FIRE where when they reach the other end, they don't want to actually retire?
I think most people who want FIRE, especially early in life, they just don't like their jobs. It's just they probably hate their bosses, they hate their management, whatever. They just don't like the jobs. And it's not something they're passionate about. And that's why they want to quit. That's how I view it. I mean, I have interacted with these guys, and almost every one of them that I've met, they just don't like the jobs. Very, very few of them will say, I want to quit this because I want to do something else. I will be working, but it is not, it may not be giving me enough income. It may not give me any income at all. I just want to do it out of passion. I want to see how it is. I want to create a startup. I want to start a freelancing, but I want to have a proper corpus base from which I can draw my income. I don't care. I just want to go to work because I love to go to work and not because I have to go to work. That's absolutely fine. If you have a proper plan of how you wish to spend your time after you quit your main job, assuming you have enough, and many people make mistakes of how much they think is enough. But assuming you've done that right, and if you have a proper plan, I think that's absolutely fine. I know a lot of people who have retired early and they keep themselves busy. But we must understand that we have to keep busy. This is the very crucial thing. I mean, every day you get up, there must be something for you to do. It may not be a 9 to 5 kind of activity, or it may not be like 12 hours that many people slog, where young people slog today. But it must be at least for 2-3 hours, 4-5 hours, or an activity. You have to go meetings, you have to talk to people, and so on. There must be some kind of activity that keeps you engaged. And are you ready to do that activity? Are you prepared enough? Do you know what it is? If you don't plan that, because FIRE planning, the it's a very holistic thing. It's not just about accumulating enough. It's not just a number. Fire planning is not just a 30x, 40x, or some kind of number. It's a proper understanding of how you're going to spend your time and how you're going to manage if for example, if this kind of poor market persists for 5 years, 10 years, can you survive? That kind of planning is there, then it's absolutely fine. But the older generation, I think it's more of I would say it's a training, it's a mental thing. That, for example, my brother-in-law has achieved fire almost 20 years ago. If you tell, I have been telling him to, why are you still working? Every time I meet him, I ask him, why are you still working? And but he doesn't thinks it's wrong to quit because he likes it and he wants to go to work, and so that's absolutely fine. And there's this, probably the older generation staying at home, not going to a proper 9 to 5 job. Maybe they feel maybe looked down upon by other people. So it's a mindset shift, and there's absolutely nothing wrong in either camp as long as the planning is done.
But like, could it be like an unhealthy relationship, especially for young people, because it sort of reframes how they look at work. It sort of creates this escapism where they want to escape their lives. They reduce work ethic as a value, and maybe they start obsessing over that number. So can it be a negative idea to look at fire as for a younger people, or do you think it's still worthwhile to have like a goal of fire?
I wouldn't be too critical about wanting
Okay.
to fire or wanting to achieve fire. I wouldn't be too critical about it as long as the planning is done right. Of course, too much thinking of anything is bad, whether fire or even too much exercise is bad for you, too much dieting is bad for you. Everything is bad for you from that point. But why do you actually need it is something that people should ask themselves. Nobody else can answer this except themselves. See, the problem is that we need to understand that all these answers lie within us, and we have to be in a secluded place where we are away from noise, extraneous noise, and find these answers for ourselves. Then I think if you have clarity about why you want fire, and people say, I'm very sure I want this, then I have no issues with it. Of course, I understand where you're coming from. There seems to be a tendency, and I can see that, including my son, that there is this tendency that people say, look, I'm working so hard now, it's really annoying. I'm working all day long, it's painful. Tell me when I'll be free. Tell me when I can be free. It's like that's hard thing to answer. So my answer to him is, are you really passionate about something? If you're passionate about something, then work will not seem like work. Work and fun will merge into something that you don't know you're doing work or you're having fun. You're doing both. That's the only solution to all this. Because if you're doing something that you hate, and you're always going to want to escape from that, and you're going to say, when do I stop this? When do I stop this 9 to 5 rigmarole? And how do I do? My problem is this passion. And I think we are in such such a fast paced world, that and so much noise around that people are not able to listen to their calling. They are not able to identify their passion, and it's very hard. How can I ask, for example, the same thing's happening with my son. He's now 17. He's now in his 17th year, and he has to make a choice about his career because he's in his 11th standard now. He's just entering 11th. How some people may not have the answer. How can I expect him to have a clear understanding of what I want to do with my life? You don't know it, and therefore people go to some degree that they don't like, get some degree that they don't like, they go to some job that they don't like, whereas that is, they don't know what their passion is, or they know what their passion is but they cannot attain it. They've gone too far away in another road, they cannot turn back and do it. So they are looking at some kind of ways to accumulate enough so that I don't have to work anymore. So I think we should not be too critical about it, but it's all about identifying your passion. I think that will solve most problems. Very few people are lucky to find it in the right age. That's my problem. You should have it in the right age. If you know, this is my true love, this is what I want to do, before they actually establish themselves as a salaried person or as an entrepreneur, if they can identify their passion, it's great. But sadly, it will take time for many. That's why all this
Right.
problem comes. I would say that's the deep rooted problem here.
Good. And there's also a lot of chatter around the fire number. I was seeing recently some people say 50 crore, 60 crore, and also what does the actual fire number look like? Does it change? Assuming a person is living like in a proper city in India, tier one city. So What does the number look like, or is it always dependent on the individual?
See, it's a very complex thing. I was called by Zero Dart to talk about retirement planning. I've done it now twice, and I was called to talk to an audience about. I thought it's 2026, and why do I need to talk about retirement planning? I thought it should be obvious to most people, and I was shocked from my interviews and so on that most people did not appreciate basic math, the simple math associated with retirement planning, where you use inflation to project your future expenses and you use inflation after retirement to determine a corpus and so on. It's astonishing that most people don't understand basic math. That is the reason why all this chatter about 10 crores, 40 crores, 50 crores, this happens because they want to react without understanding. The whole of social media can be summed up in that word. They react without understanding. They just want to react. Most people don't understand. And if you actually sat down and did a calculator, and today in today's age, you don't even need to punch in numbers on a calculator. You can just ask AI. It will do a tremendous job of doing financial planning for you. You can just ask, what do you think will be the absolute safe number for me? Because I don't want, see, if I quit my job, if I put in my papers, I don't want to update my CV ever again. That should be the goal, right? I don't want to go 2 years later. I don't want to say, no, this is not working. I want to update my CV and go back to work. That is not how fire should work. Fire means you should just, it's a one-time thing. And after that, you don't work again for, regular jobs, or that's what fire means. You can work for your passion. But the problem is they don't do the planning. And I think it's an extremely personalized thing. Just like insurance premium. For example, many people are shocked. They will go to some portal and compare insurance policies, and there'll be some premium mentioned there. But when you take a form, write in your personal details and apply to the insurer, the premium will be very different, because that premium is for you. It's based on your inputs. The same thing applies to retirement, because for some people, they will have a spouse who is working. They will be fired, but the spouse will be working. Is that really early retirement? Is debatable. But then for some people, the spouse will not work. They are the only breadwinner, and they are fired. So it's a very, very complex problem, and it's always better to be on the safe side. See, for example, the biggest risk in retirement is, if the first 10 years, first 15 years of your retired life are during a very poor market phase, like what you're seeing now. If this continues for the next 10 years and you have just started your retirement in 2025, let's say, for somebody who's just retired, then they will be in serious problems if they don't have enough money, because they'll be depleting their retirement corpus faster, and um, they could have about 50% in equity, which is wrong, and after retirement, and that's a big problem. So I think, first of all, have a plan, and you can ask AI, this is my number, this is my plan, what can go wrong with it? I think we have wonderful, our LLMs have trained themselves freely on all other people's content so much that we have wonderful assistants. We should know what to do with these assistants. That's my problem. Artificial intelligence requires good natural intelligence to be put to good use. If you don't have the right questions to ask AI, then AI is of little use to you. That's my problem. So work your own number. Don't go by 5 crores, 4 crores. How can I handle poor market returns in retirement? That's one starting point for this calculation. And one day with Gemini, or 2 hours with Gemini, 3 hours, it will sort you out. It will help you, because I use it extensively and it teaches me so much, whether it's physics or finance or anything else, or health for that matter. These are these primary reasons why I use it. And it teaches me so many things that I have not even thought about it like that. So I think we should push ourselves to ask harder and harder questions. And we know we can do this for practically for free. We don't need to pay an advisor or anybody, right? And it is way better the answers of Gemini is way better than any of the answers that you will get on Reddit, on social media, forums, groups. So why not use it and figure out your own fire number is what I would suggest.
That's a good segue into the last segment on AI. So, which I wanted to ask you about. So, on AI now, there is, of course, the positive side that you mentioned, but then there's also this idea, I mean, not idea, but this reality of layoffs where many companies are firing because of AI. There's going to be change in job roles, business models are getting changed, career projections and trajectories getting changed. So, now you have a lot of disruption. Future cash flows are getting disrupted. You don't know how the world will look like 10 years down the line. You don't even know if you'll have a job 5 years down the line. So, how does investing change now in the age of AI? Should we become more risk averse? Should we reduce equity exposure? Should we save more while we are earning more? Should we invest in like AI and AI adjacent companies? Is there any change in how we approach investing considering this development in AI?
See, I think corporates always overreact to good news and bad news. I think when there was this boom in online meetings and online businesses during COVID, and I think many of these businesses overhired people. And then you overhire during a boom and you overfire during a bust. So that's the problem with, that's how corporates are. That's how they think, because they're always hiring people based on their projected earnings and not their present earnings. And when they do that, that's when then the guy who's caught on the middle is the guy, he doesn't know, he or she doesn't know when they're going to lose their job. But this has been the case all the time. It's not because of AI. There'll always be some phenomena that comes in and you don't know what. I think because of this AI disruption, there's a huge fear. Always the corporate employees always had a fear that at the back of their minds, that what if I lose my job tomorrow? What if there's a layoff? It was in the back of their mind, but now it has come to the front of the mind, and people are so scared. And there are people today who believe that they will not be able to find work for 20 years. I'm young people. I'm talking about a 25-year-old, 30-year-old. They believe that it is hard for them to find work for 20 years, 25 years. And I think that mindset has to change. Look, if you are starting work today, let's say you are 25 or 28, you just started work, or maybe 2-3 years experience, whatever it is, depending on your education and so on. You cannot say, I'm going to lose my job. Okay, you're going to lose your job in one company. What will you do after that? You must have a plan. Nobody else can answer this except you. You have to be employed gainfully for at least 15 to 20 years. Only then there is a chance of financial independence and accumulating money and so on. Otherwise, there's no, you can forget about it. If you say, if one company lays me off and I'm just going to sit at home, or not, you're not going to just sit at home, right? You're going to find something, So I think that confidence is completely gone. I'm so scared. Just in last 1 year, people don't have that confidence they'll get employed again. That is very scary for me. I mean, okay, somebody's going to lay you off. You have to put food on the table, right? So you have to be the breadwinner. So you must do something to find employment. And therefore, I would say, first focus on that. Build yourself a very strong emergency fund, few lakhs. If you are so scared of your job that you will lose it any day, build a super solid, robust emergency fund, maybe 3 lakhs, 4 lakhs, 5 lakhs, as per your mileage, whatever you can manage. Then think real hard before taking a home loan, because home loan, what happens in India is people buy a home loan for 15 years and they will repay in 7-8 years, which is, I'm talking about a situation where there is no job disruption, or at least the pre-AI era. That was what happened. That happened in the pre-AI era. Now, I think you should be very scared about even taking a home loan for 15 years. And you should, I'm not a big fan of, I've never been a big fan of, being in a hurry to pre-close your home loan. But if you're so scared of job disruption, have yourself an emergency fund, keep some EMIs at bay, somewhere else, and then run the home loan maybe for about 10 years. It's okay. But invest. You need a corpus. First, you need to be employed. You need to manage your debt. You need to invest. You need to have a corpus. So I really think that it's very hard for me to answer this, because people accuse me saying, you have a nice tenured job, you don't have to worry about job disruption and so on. This is true, but think about it from a practical point of view. You have to find a way to stay employed. If it means switching from a white collar job to a blue collar job, so be it. There are so many people who have done it, switched from this to that, and they have made money. So you must be ready for anything. If you're so scared of losing your job because you think I'm a low level programmer and AI can do my job, I don't think I can manage, then you be ready for something like that. Because I know people. There was a very interesting case of a reporter who said, I'm going to lose my job. I'm going to earn my money, doing Swiggy, running deliveries on Swiggy. But that kind of mindset is necessary. I think you need to have that mindset, and fear is not going to help. You must have that mindset. Look, whatever happens, I'll find my way. Okay, I may not earn a lot of money. I may not invest a lot, but at least I'll keep my family afloat. I'll pay my dues. I'll pay my EMIs. At least to that much, I must have that confidence. I'm saying this particularly because there's a very pertinent questions that you asked me, and I'm very, very scared about how young people are reacting to AI disruption. They're acting as if that they'll be sent home and they'll stay at home forever. I think that's not right. I think human beings will find a way. They will find a way to survive, and I think we should have that confidence to do that. I'm not sure if I answered your question right, but this is how I feel.
No, yeah, right. I think many people are just more fearful and anxious. And the short term pain, yeah, it will be there. But I think as long as one is resilient, trying to build things, trying to do things, it should work out.
Yes.
One final, yeah,
Yes. Sorry.
go
To
ahead.
add, upskilling is a very common thing that people advise, especially the IT guys. Oh, you should upskill yourself. I'm
Yeah,
not sure that's so easy. It's not easy
yeah,
to upskill yourself just like that, because it's going to take a lot of time and effort, and you don't know whether that skill will pay off in the future or not. Because
yeah,
if it's a sure shot skill, because that skill is also changing, because now if you have AI, that's going to learn that skill as well, and you don't know whether it's going to upstage you then. So it's a very, very, very difficult situation. I can understand the pain, but you
yeah.
must survive, and I think we human beings will. So sorry to interrupt.
Yeah. No, no, it's fine. And I feel it's very relevant because I, like 5, 6 years ago, I don't work in a coding field, but 5, 6 years ago, there was talk about you should learn to code, you should learn Python to improve and all. But then now when I look at it, you don't need that skill. So there was no point in upskilling back then in programming. And one final thing that I also wanted to touch upon or related to AI is now you have these powerful LLMs. Intelligence is somewhat cheap. You can get really strong models from the access of your phone. So now does it become easier for the retail investor to actually beat the market? You can have your own research analyst, you can have your portfolio manager, stock picker. Does this create a scenario now with AI where you're working 9 to 5, but your AI on the side is building your portfolio, trying to beat the market? Or is it the case now with AI with such powerful intelligence model, it becomes much harder to beat the market since everything is efficient? So, what are your views now with this agentic AI intelligence becoming so cheap and beating the market?
I don't think it's a good idea to use AI to try and beat the market or get more returns than the market. I don't think that's going to be so easy. Yeah, you're right. Efficiency becomes so much better. The flow of information becomes so much better that the number of people with lopsided information will diminish very fast. And actually, I'm very surprised about how index investing has caught on in such a big way in India. I don't think in the US also the index investing caught on in such a big way. It took a long time for the US markets to for the index AUM to be significant in the US markets. But in India, it really caught on like wildfire because of the internet, because of the kind of information that we have everywhere, the spread of information that we have everywhere. But I believe that financial advisors will be threatened by AI. AI is a big threat to all these people. Financial advisors, SEBI registered investment advisors, financial planners, stock analysts. I think AI can analyze a stock much better than any analyst. If you are looking at an analyst who knows only basic balance sheet based formula analysis, that AI can do. I don't need you, or you don't need me. But if you want somebody to give you inside information, that AI cannot do. Because if you ask the old time stock traders, they will tell you, unless you know somebody in the management, don't buy a company. That's the kind of information they tell you. They'll tell you there must be something, some inside, whether it's legal or not, whether it constitutes insider trading or not. That's a different matter. I'm not getting into that. But I'm saying there should be some basic information that you should have that makes you believe that this is a good buy or a good sell, right? And that information AI cannot provide. What AI can do is, instead of you searching 50 web pages and coming to one conclusion, AI can do it in seconds. That AI can do. But information that's not out there on the web, I don't think AI can help. So trying to beat the market, I'm not sure it's a good idea using AI. But I think basic financial planning, structuring debt, all those ideas, I think those professionals, they should be threatened by AI. I think especially the new generation. The older generation, they may want to talk to an advisor, but today a 20 something, when they become 35 or 40, that's when people go to advisors. They won't go to advisors because AI would have developed so much, and you can see how much it has come in just 2 years, 3 years. And I think that there's a big threat for that kind of industries, and therefore the regulation also must come in. SEBI should regulate this, and it becomes a nightmare for, I think it's a nightmare. AI is a nightmare for SEBI. All they can say is, no, there should be a human touch. That is it. The results will be produced by AI, and there must be human vetting. Humans are prone to errors. People say, oh, AI can make mistakes. Humans can make more mistakes than AI. Actually, I would say I would trust an AI more than I would trust a human. But as a regulator, they must have a human. Otherwise, they will have problems with everybody. So it's a nightmarish scenario for everybody, especially in the fintech. But at the same time, it is a new toy. It is still a new toy. I think there can be some kind of equilibrium. Just like every technology comes in and we think of it as a disruption, but we find ways to live with it. We find ways to work around it, through it, and so on. I think we will do the same with AI. So there will be some kind of equilibrium state where we can survive. Right? Just like what happened in the movie industry. When the movie industry encountered television as a new technology, they thought they were finished. Because people can sit at home, nobody will come to the theater. But they survived. And then came the OTT, that's another threat. But they survived. They are now, the OTT guys are producing movies. And we now have the big movies coming in. The Hail Mary was the biggest OTT hit on theaters, right? It was the first OTT platform produced movie, huge hit. So there's a big change. So we find ways to adapt. We find ways to come up to fight these disruptions. That will happen with AI also. I don't know how. I don't know how to predict the future. But I'm confident that we'll find a way to live with it and keep our jobs in some way.
All right. On that very note, thank you so much, sir, for coming on the show and sharing your views. It was very excellent talking to you and getting these different perspectives. Thank you so much.